Welcome to the Opening Bell Report.
Okay, so let's start today off with a quick vibe check. If you have been watching the markets recently, and specifically, specifically if you've been staring at the chart for AST SpaceMobile, ticker ASTS, you are probably feeling a very distinct sense of motion sickness.
It has been a really volatile ride.
That's right.
And motion sickness might actually be putting it politely for some investors out there.
Right. I mean, look at the signals we've been bombarded with lately. You open your trading app and you see a daily drop hitting 7%.
Right.
You see major brokerages slapping these lukewarm hold ratings on the stock. You even see insiders selling off shares.
Yeah.
So if you're just glancing at the headlines, the signal seems pretty loud and clear, right?
Yeah.
It's basically telling you to run for the hills.
Or at least you know that the party is over.
Yeah.
It is a classic setup for investor anxiety. The clouds are gathering, the red arrows are flashing, and the sentiment is just undeniably heavy right now.
Exactly.
Right.
But, and this is a massive but that we need to unpack today for you, we have an analysis report in front of us titled The AST SpaceMobile Disconnect Forecasting a 700 Million Surge.
It's a great report.
And the premise of this analysis report is just wild. It's arguing that if you are panicking over the stock chart right now, you are basically looking at a mirage.
Yeah. Or, more accurately, you're looking at the past while the math is screaming about the future.
Exactly. So that's the disconnect we need to talk about. It's really a story about two parallel realities.
You have the emotional reality of the market right now, which is fearful and cautious and totally fixated on the downside.
Right.
And then you have the mathematical reality of what's called an S-curve trajectory that this analysis report argues Wall Street is completely ignoring.
So that is our mission for this deep dive. We are going to figure out why this report claims Wall Street is sleeping on a projected revenue forecast of over $760 million.
Which is a huge number.
We're going to look at the numbers that are hiding in plain sight in these models, and we're going to answer the big question for you. If the future looks so bright, why does the present feel so gloomy?
It really is a fascinating case study in market psychology versus raw financial forecasting.
Let's jump right into the elephant in the room then, the numbers, because this is where the disconnect is the loudest and, frankly, where your skepticism should probably be the highest.
Right. To understand where we're going, we have to be honest about where we are.
Yeah.
And if you look at the current snapshot of AST SpaceMobile, it is easy to see why the critics are so loud.
Because in the third quarter of 2025, they generated $14.7 million in revenue.
Exactly.
Which, okay, $14.7 million isn't zero. It was actually a pretty big jump from the previous year, percentage-wise, but in the grand scheme of things.
In the context of Wall Street, it is completely microscopic. You have to remember, this is a company with a valuation hovering around $29 billion.
Right.
So you have a nearly $30 billion price tag on a company that's bringing in roughly $15 million a quarter.
I mean, if I pitched you a lemonade stand worth $30 billion that only made $15 million, you'd laugh me right out of the room.
Exactly. And that is why you see analysts penalizing them. If you look at ASTS strictly as it stands today, it looks like an unprofitable enterprise with a massive bloated valuation.
It looks like a bubble waiting to pop.
It really does.
Okay, so that's the current reality. That's the rearview mirror. But here's where the report says everyone is getting it wrong. While the market is obsessing over that $14 million number, the consensus aggregate forecasts sitting in the institutional models are painting a picture of, and I don't use this word lightly, hypergrowth.
This is that S-curve we mentioned. In technology, growth rarely happens in a straight line. It stays flat for a long time, which is the bottom of the S, and then once the infrastructure turns on, it goes vertical.
Let's walk through that vertical part, because the report breaks this down year by year, and the jumps are, well, they're kind of jarring.
They are.
Let's start with the next 12 months leading into 2026. What are the models showing?
So for 2026, the consensus revenue forecast jumps from that tiny 14 million baseline up to $225.8 million.
Okay, so we go from a rounding error to almost $250 million. That's a growth rate of over 1,100%.
Correct. But here's the thing. In the model, 2026 is just the warm-up act. The report identifies the next 24 months, essentially the year 2027, as the critical inflection point.
And what's the forecast for that period?
$761.8 million.
$761 million, so we triple again.
And then if we look just 1 year further to the next 36 months or 2028, the number absolutely explodes. The forecast sits at $2.6 billion.
$2.6 billion.
That represents a total growth rate from today of 13,881%.
Okay, hold on. I have to play devil's advocate here for you listening, because plus 13,881%, those numbers sound like pure fantasy. Is this just some guy on a forum drawing lines on a chart, or is this real data?
That is the most important distinction to make here. These are consensus aggregate forecasts. That means these numbers are pulled directly from the financial models of the institutional analysts who actually cover the stock.
Oh.
Yeah, these aren't fan theories. These are the actual numbers that major banks and firms are using to model the future cash flow.
So the institutions know these numbers are there. They have $2.6 billion sitting in their spreadsheets for 2028.
They do. It is sitting right there in the cells.
And here is the puzzle at the center of this entire deep dive. If I told you I had a savings account that was guaranteed to grow 13,000% in 3 years, you would put every dollar you owned into it.
Without hesitation.
So why is the average price target on Wall Street stuck at a cautious $89? Why are the institutions, as the report says, sleeping on this?
It is the multi-billion-dollar question. And the report breaks it down into 3 specific reasons. Think of them as 3 heavy blankets that are smothering the stock price, keeping it asleep, despite that massive growth on the horizon.
Let's unpack reason number 1 then. The report calls it the valuation hangover.
This is really about market psychology and the mechanics of how stocks move. First, we have to remember context. ASTS has already delivered a generational rally.
Right.
In the trailing 3 years, this stock is up over 1,200%.
Which is incredible. If you got in early, you've already won the lottery, essentially.
Absolutely. But stocks don't just go up in a straight line forever. After a run that hot, a stock needs to digest the gains. Investors take profits, the momentum slows down. That's totally normal behavior.
But there is a technical problem happening underneath that with the institutional algorithm.
Yes, the algos. It always comes back to the robots.
How are they viewing this exactly?
Well, modern markets are heavily driven by automated trading. These algorithms are programmed to look for specific metrics to determine value and risk. One of the biggest metrics is the price-to-sales ratio, or PS.
Right.
But here's the catch. Most algorithms calculate that ratio based on trailing revenue.
I see where this is going. So the computer looks at the last 12 months, sees that tiny 15 million or so, compares it to the 29 billion valuation, and hits the panic button.
Exactly. Through that lens, the stock looks astronomically overvalued. The algorithm sees a massive price and tiny revenue, and it flags it as high risk.
It's like driving a car while only looking in the rearview mirror.
That's a great way to put it. The algorithm sees where you've been, which is making very little money, but is completely blind to the giant mountain of cash on the horizon because technically it hasn't happened yet.
And it's not just computers doing this, right? Humans do this too.
They definitely do. Conservative fund managers operate the exact same way. They are risk-averse by nature. They see the projections of 2.6 billion, sure.
But to them, a projection is just a guess.
Exactly. It's a guess until it happens. These managers are waiting for that revenue to actually hit the income statement.
So they are sitting on their hands. They won't update their risk models until the money is literally in the bank.
Precisely. They are looking backward while the S-curve is looking forward. That gap, that time lag, is the first part of the disconnect.
Okay, so that explains the financial math problem. But reason number 2 moves us from the spreadsheets to the real world, or I guess the orbital world.
Right into space.
The analysis report calls this execution and manufacturing anxiety.
Because at the end of the day, you can't generate $760 million in revenue with a spreadsheet. You need satellites.
Specifically, ASTS needs to deploy dozens of their commercial Bluebird satellites.
Right.
And this is a massive physical challenge. Management has promised they're going to ramp up manufacturing to 6 satellites per month by the end of the year. That sounds impressive, but is it realistic?
It is impressive, and they do have the facilities for it. But here's where we run into a cultural rule of Wall Street. There is deep skepticism regarding aerospace timelines.
Why is that? Is it just history repeating itself?
Basically, yes. Historically speaking, space is hard. It is expensive, and delays are the norm, not the exception.
Right, rockets get scrubbed due to weather.
Exactly. Weather supply chains get snarled. Testing reveals bugs that take months to fix. Wall Street has been burned so many times before by promising space companies that couldn't stick to a schedule.
So even though ASTS is promising 6 satellites a month, the analysts are thinking, yeah, let's see you do it first.
Exactly. It's a show-me situation. The logic is simple. Any delay in the launch schedule directly pushes back that revenue timeline we talked about.
Because if the satellites aren't up there, they can't beam down data and they can't bill customers.
Right. So analysts are hesitant to slap a strong buy rating on the stock until those satellites are physically in orbit and unfurled.
They are pricing in the risk of delay. They are assuming something will go wrong because in aerospace, something usually does.
They are discounting for execution risk.
Okay, so we have the valuation hangover and we have the manufacturing anxiety. Now let's look at reason number 3. And this one probably stings a little bit for current shareholders, the dilution discount.
This refers to the recent financial move ASTS made. They did an upsized $1.075 billion convertible bond offering.
Now, $1 billion is a lot of cash. The report calls this a strategic masterstroke. But usually when a company issues bonds or sells shares, shareholders get angry because their piece of the pie gets smaller. Why does the report call this a masterstroke?
Because it solves the biggest existential risk for the company, which is running out of money. Before this raise, there was always a question mark. Does ASTS have enough cash to actually build the constellation?
So by securing over $1 billion, that question is answered.
Exactly. They are fully funded for the rollout.
So from a business perspective, it secures their survival. But the stock price took a hit anyway.
Because of the mechanism. It's a convertible bond. Without getting too deep into the weeds, this implies that eventually that debt can turn into shares.
And that creates dilution. More shares in the pool means each existing share you hold is worth a tiny bit less.
Right. And there is a hedge fund angle to this, too.
I was going to ask about that. How does that work?
There often is with convertible bonds. When big institutional investors buy these bonds, they often hedge that bet by shorting the common stock at the same time.
So it's an arbitrage play.
Exactly. So you have this mechanical selling pressure pushing the stock price down, even though the company is fundamentally stronger because it actually has the cash it needs.
So the dilution discount acts like a temporary lid on the stock price.
Yes. Analysts often hit the pause button on price target upgrades immediately after a massive capital raise until the dust settles on the share structure. This contributes heavily to the current sleeping sentiment.
So we have these three heavy blankets weighing down the stock. The high valuation based on cash sales, the skepticism about building satellites fast enough, and the recent dilution. It makes sense why the stock is stalled.
It does. The market is acting rationally based on the present risks. It's waiting for a sure thing.
But the report argues that this is temporary. It says the narrative is going to shift, and it's going to shift abruptly. From speculative R&D project to cash printing utility.
That phrase, cash printing utility, is the key to all of this. Utilities are boring, predictable, and profitable. Think of your water company or your electric company. That is where ASTS wants to be.
So how to get there? The report identifies two specific milestones or catalysts that are going to wake Wall Street up. Let's look at the first one.
Milestone number 1 is the beta service launch.
This is the rubber meeting the road, or the signal meeting the phone, I guess.
Exactly. Market is waiting for the official rollout of continuous beta services. The analysis report targets the first half of 2026 for this.
And we aren't just talking about testing in a lab anymore. We are talking about partners like AT&T and Verizon.
Huge established players. When AT&T and Verizon start actually using the service for their customers, even in beta, it validates the technology in a way that nothing else can.
It proves it works at scale.
Right. It tells the market this isn't a science experiment anymore, it's a real product.
And that leads directly to milestone number 2, which sounds like the financial holy grail here.
Conversion to active billing.
This is the moment I find most interesting because the business model here is really unique. If you're a listener, you don't go to an AST SpaceMobile store and buy a SIM card, right?
No, and that is the absolute brilliance of the model. It is BDT, BDC, business to consumer.
So you just keep your AT&T or Verizon plan?
Yes, you keep your plan. You just get a text message when you step out of coverage saying you're out of range. Would you like to add a SpaceMobile Day Pass for $5?
You click yes, and it just works.
It just works.
And ASTS gets a cut of that $5.
They get a massive cut. It is a wholesale model. ASTS collects a fee from AT&T for providing the connection.
And because ASTS doesn't have to pay for marketing or retail stores or customer support centers, because AT&T handles all that, their margins are projected to be incredibly high.
Exactly. Explain that wholesale margin part a bit more. Why is it so profitable?
Well, because the costs are fixed. Once the satellite is up there, it costs roughly the same amount to operate whether one person uses it or 1 million people use it.
Right.
So every additional dollar of revenue is almost pure profit. That is why the models show such explosive growth.
And that is the transformation. When active billing starts that $760 million forecast we talked about at the beginning, it stops being a guess.
Right. It transforms from a projection into a highly predictable high-margin reality.
And that is the exact moment the sleeping institutions wake up. Because suddenly the risk isn't theoretical anymore. The cash flow is real.
And the PS ratio we talked about earlier, suddenly the denominator, the sales part explodes and the stock actually looks cheap. So let's bring this all back together for you listening. We started with this tension, right? The fear in the market versus the optimism in the data.
The summary is really this. The numbers point to hypergrowth. I mean, we are talking about up to 13,881% growth in 3 years. That is undeniable in the consensus models.
But the market is currently paralyzed. It is paralyzed by valuation fears, it's paralyzed by skepticism about manufacturing, and it's paralyzed by the recent dilution.
And so What for you listening to this? Why does this matter to you?
It matters because it reveals how Wall Street actually works. The report concludes that Wall Street isn't necessarily betting against ASTS.
They aren't saying it won't happen.
Right. They are simply waiting for the risk to drop to zero.
They want a sure thing. They want to see the money in the bank.
Exactly. They are risk averse. They would rather buy in later at a higher price when they know it's safe than buy in now and risk being wrong.
But, and here is the final provocative thought I want to leave you with straight from the report. By waiting for the risk to drop to zero, what are they giving up?
They are leaving a window of opportunity open. They are giving up the alpha, the big gains that come from taking the risk before the outcome is certain.
Exactly. If the market waits until 2027 or 2028, when the $2.6 billion is already there, the stock price will likely reflect that reality.
It will be priced as a boring, safe utility. The disconnect will be gone completely.
It raises the question you have to ask yourself. Is the market's caution a warning sign that you should heed? Or is that caution exactly what creates the opportunity for forward-looking capital to get in before the crowd?
Are you driving looking at the rearview mirror like the algorithms, or are you looking at the S-curve on the horizon? That is the real question.
It's the classic investor dilemma, comfort or potential. You rarely get both.
Something to really mull over. Thanks for diving deep with us today into this analysis report. It's going to be a fascinating year to watch this play out.
Always a pleasure.
Catch you next time.
Don't forget to like, share, and subscribe for more.